Forecasting investment performance is a little like forecasting the weather. Tomorrow's weather will be the same as today's unless something changes. And the key to the weather is the barometric pressure. That's what the lines on the weather map are all about, with highs and lows moving across the country bringing rain or shine. And depending on the extent and the rate of the change, they can generate wind or calm. The investment climate is driven by two key elements. The first is changes in the underlying value of investments, and when we're discussing shares, the underlying value comes from the profit being generated. The line on the chart shows the annual percentage changes in profits from Australia's largest industrial companies over the past 20 years. On average, profits were flat or rising in 17 of these years, but they fell by around 10% 3 times. Share prices generally move in the same direction as earnings, but with greater volatility. This introduces the second element of the investment climate, valuations. In the long term, changes in valuations average each other out, but valuation changes can have a tremendous impact on investors, and this can persist for many years. Middletons Barometer considers 5 factors that will impact on earnings and/or valuations. These factors are the value of our currency, inflation, interest rates, and economic growth both here and overseas. What we'll never predict is the influence of exogenous factors like wars or global crises. Generally, a falling Australian dollar supports earnings growth in Australia, and it also provides additional earnings growth for Australians with international investments. Low inflation is good for investors, and it also promotes healthy valuations. Low interest rates have the same impact, and most of the time inflation influences interest rates, but not all the time. When the economy grows, some of the growth finds its way into profits, so growth is good. International economic growth is clearly good for international investments, but Australia finds it easier to grow if the rest of the world is also growing. The impact of external shocks on earnings can be anything really, but the market always hates uncertainty, so the impact on valuations is always negative in the short term. So what about the value of the Australian dollar? Well, it's a commodity currency. When the price of commodities, that's minerals and agricultural products, increases, then so does the value of the Australian dollar. It's been that way since the currency floated 30 years ago. Between 2005 and 2012, the value of commodities almost doubled in real terms, and so did the value of the Australian dollar. But the supply of commodities has increased, and the rate of demand growth seems to be slowing. There will likely be a further deterioration in commodity prices, driving the currency lower. Economists tell us if there's money to be made, then someone will try to make it, so the level of supply will continue to grow, and this will cause prices to fall further. It all stops when it's no longer worth producing more. Prices are still well above the marginal cost of production, so further price weakness seems likely in the medium term, and along with it, further falls in the value of our currency. Inflation is likely to remain low through 2014 because there's still excess capacity around the world. Also, international energy prices are likely to remain low or even fall, although we may not notice it here as the value of our currency comes down. In the medium term, though, the probability of a spike in inflation is higher than it's been for over 20 years. In Australia, our falling currency will increase the price of manufactured goods, most of which are now made overseas. Also, an avalanche of retirees is likely to keep labour markets reasonably tight. We could also import some inflation from overseas that comes as a payback for all the money printing that's been going on in the USA, Europe and Japan. We think that inflation will go back up, but by how much, well, who knows? The most likely outcome for interest rates is that they'll remain low throughout the developed world in 2014. But at some time they have to return to normal, and they may even overshoot if inflation kicks in. Economic growth is likely to be patchy here during 2014. You can hardly miss the constant commentary about the end of the construction phase of the mining boom and the need for the Australian economy to transition to something else. Well, it might take a while. Overseas, however, the developing world never stopped growing, and things are starting to look up elsewhere. Well, they had to really, because throughout Europe and the USA things have been pretty grim recently. In the medium term, Australia will start to get its mojo back, and elsewhere we could see some really strong economic growth emanating from the more sustainable platforms created by the financial crisis. Finally, what about valuations? Well, share valuations in Australia and overseas increased in 2013, but they've really just caught up with where they should be. Shares aren't cheap anymore, but they're not expensive either. We wouldn't be surprised if valuations keep rising in 2014, driven higher by low interest rates, but if it goes too far, it'll become a dangerous game. Interest rates will eventually go back up, and if they spike in line with inflation, valuations can fall, and perhaps by quite a bit. So here's the bottom line. 2014 looks benign, and the only drag on outcomes could well be restrained economic growth here at home, making earnings growth hard to find for our local companies. With stronger growth likely overseas and the possible weakness of our currency, it may make sense to increase your international exposure. The medium term's trickier. Inflation can spike, interest rates might jump up, valuations can fall, so a new bout of turbulence isn't out of the question. Actually, the investment climate's always changing, so make sure you talk to the guys with the barometer.